following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
And the next act in our show is called Roadblocks to Your New Options Business. And Roadblocks is maybe a little bit of misnomer. What we're going to talk about really some of the issues that you're going to have to deal with in terms of actually setting up and running your business. And yes, there are roadblocks, but there are also some very positive things that we want to talk about. I'm Earl Humphrey. I'm a partner in a consulting firm called Ion Advisors. We're based in Palatine, and we specialize in working with early stage companies, helping them find funding, helping them assess their overall viability. That's one of our biggest sort of issues, is trying to help people understand they've got a great idea, but can you actually turn it into a business? And then the other part of our business is we do what we call acquisition forensics, that we work with due diligence teams and helping them do deeper levels of research when they're looking at acquisitions, and a lot of that really has to do with assessing the growth potential for the acquisition candidates. Joining me today is Andrew May. Now, Andrew, talk a little bit about his background.
Sure. Thanks, Earl. Andrew May, I'm a securities and compliance attorney. Also represent clients in the commodities space as well. Just a little bit about my background. I also write a blog called Securities Law and Compliance, which is on WordPress. So maybe you guys have seen some of the material. But I am an attorney for practicing 18 years. I used to work in-house at a SEC registered money manager and investment advisor, broker dealer as well. I worked at a number of different firms, securities and commodities boutique firm here in Chicago. Started my own firm. Worked in major law firms, minor law firms, things like that. But generally what I do is work with a lot of securities-related entrepreneurs and act as kind of a general counsel to a lot of startups.
I'm Justin Braun. I got in this space about a little over a decade ago. I was originally a systems administrator for Advantage Futures. Afterwards, I left to go run the technology department of a prop trading group. Left there, I spent a few years at Trading Technologies, where Trading Technologies was primarily a futures execution vendor. And this, projects just sort of fell on my lap, and it was a couple of guys in Arizona who wanted to quote options. And at the time, I didn't even know what Greeks were, but I sort of, fell into this thing and wrote a little bit of software that allowed TT to live quote make markets and options. And after a few months, I really thought that I had something here, so I, left and started my own consulting company that does trade execution software consulting, and we've also built our own trade execution platform. It's a very highly automated type thing. And I've been doing scale dynamics for about 3 years now, and that's about it.
Part of the reason we asked Justin to be on a panel is Justin has actual experience starting a company from ground zero and actually building it, which we thought was an important aspect, and have somebody that can actually, keep Andrew and I honest with some of our comments and some of the things that we're going to talk about, and actually have somebody who's actually had hands-on and done it. I've started a couple companies, but not that they've been totally outside of the option space, unrelated. We wanted to have somebody that was actually in this space on our panel. So, one of the things that happens today, we were talking about, if you think about today, it's very easy, in a sense, to get lulled into the idea that you can start a business real quickly, which you can, but you don't really necessarily, you get sort of lulled into this idea, okay, I can go out there, there's all these cool resources that are out there to help you start a business, but you don't necessarily dig deep enough to look into saying, is it actually viable? And that's one of the sort of key things like we run into like in my consulting practice is people come in with all kinds of cool ideas, but when you sit down and start digging into it, you find out, is the business actually viable? And one of the things that will happen is in the next panel when they talk about marketing and sales, they're going to show you a lot of sort of interesting and cool stuff that you can do today with the web and social media tools to really assess the viability and determine, do I actually have a product or service I can sell to people and actually make money with? Once you sort of make that determination, then you've got to start back filling in with all of the sort of details about what it takes to actually set up a business. And depending on the type of business that you're setting up, there are a lot of sort of really pithy issues relating to regulation and licensing, that kind of thing, and that's what we're going to talk about. So to kick things off, we're going to start the discussion with Andrew to just sort of talk about some of the overriding issues that you're going to have to think about if you're going to get into an entrepreneurial business in options and derivative space. So take it away, Andrew.
Alrighty, so we're going to cover this at a 10,000-foot level, but these are really issues for any business, whether it's option-related or not. But each one of these things is something that can really kind of wreck your business. And so we've heard a lot of success stories from the first panel about people who started their own business and bootstrapped it and everything like that, but is your business that you're building based on a foundation of sand that can get washed away with one wave? Hi, we're here from the SEC. We'd like to examine your books and records. What do you mean you're not registered? Something along those lines. So the four considerations we have are cost, paperwork, limited liability, and taxation at the entity level. I'm going to be going over each and every one of them, but choice of entity. Limited liability is one of the things you're looking for. So are the business owners responsible for the debts of the business? In the best scenario, the answer is no. Talking about corporations, limited partnerships, limited liability companies, the entities that protect the owner's assets from the business debts or torts, negligence of the employees. If the answer to that is yes, which is a sole proprietorship, person in business by himself, or a partnership, which we'll be finding, but they don't protect the business owners from the business debts or torts, think negligence. And the very famous example from law school, Burt Reynolds' failed restaurant in LA and the problem of general partnerships. Well, Burt Reynolds, very famous movie star, had a celebrity restaurant, wasn't so successful. It was a partnership. Somebody screwed that up. So Burt Reynolds' personal assets are, the creditors can go after his personal assets. And he had a long-term lease, cost him a lot of money. That's, probably malpractice on somebody's account, but I've recently seen somebody come across my desk. They wanted a referral for a bankruptcy attorney. They've been practicing as a pharmacist, something along those lines, for 20-something years, or an obstetrician, I think it was. Anyway, they've been practicing for 20 or 30 years, and guess what? They're about ready to retire, and they're going to bankruptcy court because they didn't have the right choice of entity. Taxation at the entity level. What you want is flow-through taxation. Owners pay taxes based on the percentage of ownership. Inefficient to have company profits and dividends received by owners taxed, which is double taxation. So the flow-through taxation that you want, LLC, limited partnership, and S corp are not taxed at the entity level. C corporation, think Microsoft, is taxed twice, once at the entity level and once on the shareholders' dividends. So in the taxation we're referring to as income taxes, not other sorts of taxes. Okay, so one of the things you want to look at, and it's really not turning into this conversation, I'm not going to go through the costs and paperwork to set up different entities, but there are two other considerations you want to think about. Simpler isn't better. You're back to our defending Burt Reynolds. Partnership is defined as two people in business together for profit. Need not file anything or pay any money. Well, that's great. You can be up and running today. But the problem is that your personal assets are at stake. And if one of your partners screws up on a trading error or something like that, you're a partner with them, they can take your house. So, difference between being an employee and an owner, payroll taxes. So, as an employee, you pay 6.2% for Social Security and 1.45% for Medicare, and the rest is paid by the employer in equal amounts. A person who's self-employed, you pay both sides of that, over 15% in addition to your income taxes. So, a lot of people, they go off on their own, they're making money, they're doing really, really well. How come they're not keeping as much? The reason is now they're paying double the payroll taxes they had to before. So agreements and contracts, these are things you need to consider. Oral contracts are valid but fraught with peril. Written contracts are better but still present problems. Can you limit litigations with an arbitration clause? Can you limit your liability? Think lost profits, something like that. You're an investment advisor. If somebody, you screw up an order execution, you don't want to be responsible for their lost profits. And then consider a restrictive covenant, which is a non-compete. Somebody steals your technology, goes across the street, and tries to compete with you. And then the other way to kill any new venture is litigation. It's expensive to be at the, what we call the Daily Center. Most of us call it the Daily Center, and the attorneys call it the Delay Center. 6 years to get to a jury trial, you can spend a lot of money on attorney's fees during that time. Help for your business, independent contractors versus employees. So the difference between being an employee and an independent contractor, why does this matter? Again, torts, liability for negligence, if you're, and we'll be getting into it, and payroll taxes again. So employees mean greater payroll taxes, the 7.5% roughly on their wages, and you're liable for their torts, things negligence. That could be a delivery driver, or let's be real, we're talking about the financial services industry, sexual harassment, something along those lines. Independent contractor, no payroll tax liability for the new business and not liable for torts. What are the factors determining the nature of the relationship, what the contract says, control over the work, how much control you have over your employees or independent contractors, whose tools are used, computer, etc., where the work is done. Buy-sell agreements. I know a lot of people have heard that, but how many people really know what a buy-sell agreement is? Some people not. Buy-sell agreement is a prenuptial for business owners. What happens, and the time to do it is when everyone's getting along in the beginning, as opposed to when people are at each other's throats. What happens if one owner dies, is disabled, or wants to buy out the other? You went into business with someone, but you may not want to be in business with your spouse, kids, or ex-wife. It's often funded with life insurance. Anyone's interested, I have an article from the New York Times that talks about people who didn't have buy-sell agreements and they got enough out of their business to basically pay their lawyers' fees. So it's another trap for the unwary. Intellectual property concerns, trademark, service mark, patents, copyright. It's a specialty legal practice that I farm out to other people, but oftentimes you don't want to get the dreaded cease and desist letter. Someone's claiming that they're using your name or something like that. Guess what? You've been having your business for 5 years and you have to come up with a new name. There's also patent trolls out there, and a lot of people who are professional litigators when it comes to this sort of thing. So we're now going to talk about the registered investment advisor.
Okay, thanks, Andrew. Before we go on, okay, so Justin, I'm going to turn it over to you. Okay, so you saw this sort of quick run through. Here's the stuff you got to deal with, the details and things. So give us your perspective about what you went through in dealing with this in your startup.
So I'm a big fan of sort of, especially because all of these things directly translate into time and distraction from what you really want to do, which is go out there and build a product and take it to market and start selling it. And all of these things are incredibly important, but I've always taken a kick the can down the road approach to these sorts of things. And you may say that this is, risky or Andrew says, what is it, an ounce of prevention or a pound of flesh or something like that? A pound of care. And so generally with these sorts of things, I actually tend to take the opposing view to that and say, in an ideal world, you would prevent all of these things up front. But when I started Scale Dynamics, I did it with $7 in my checking account, and there was literally no time to form everything properly. I had to immediately be cash flow positive and get going, or I wasn't paying rent. And so that was exactly what I did. And as soon as I got a customer who handed me a contract that required that I carry certain professional liability insurance, then I looked to purchase it. When I went to when the work balance became enough to where I couldn't do the work by myself and I had to go hire somebody, then I started to look at, do I want to bring in a contractor? Do I want to hire an employee? And I have certain levels of what will I hire, what will I subcontract out for, and what I make those decisions, but I always try to make those decisions crossing bridges when they get to it. Now, don't get me wrong, preventing is important, and you have to be aware of all of these pitfalls. But to say that you have to address them right up front before you even get started, you'll spend 3 months doing this and not making money during the time that you're doing it, I would say, step into it before and get your feet a little bit wet and address these things as they become necessary.
The one thing I would say about that is, in kind of my approach to law and the legal profession, we get a lot of things that come across people's desks. They warp your mind in law school. Planes that fall from the sky, people who amputate the wrong leg, and literally the things that are on my desk, no one could have imagined that they would have kind of occurred that way. But I guess the one thing that I will tell you is hiring an attorney can be expensive, but it can be really, really expensive at the end when you're playing the hand that you're dealt. Nobody wants to pay for the ounce of prevention because you may not need it. It's like insurance. Do you think that when you bought the life insurance and you didn't die, it wasn't worth it? I guess the other thing is, oftentimes people who practice in the industry, listen, sometimes a flat fee is a win-win. It's a win for the entrepreneur. It's going to cost you a flat fee. If I made a mistake and didn't charge you enough, well, that's kind of on me. So sometimes I can make more money on a flat fee than an hourly basis. We've all had relatives or somebody who used an attorney and it ended up costing them kind of an arm and a leg. That is the one thing that I would tell you is, sometimes you look into whether somebody can do it cheaply or on a flat fee or something along those lines. And then Justin's right. Justin is right that you can't start the perfect operating or the perfect business plan. A business plan is a tool. It's not a thing in and of itself. And I've seen people who want to get the business plan perfect before doing anything, and that's simply wrong. And you're out there. You should be out there kind of honing your skill and your craft and working on your business, not necessarily coming up with the best business plan.
Yeah, and the world does provide a lot of feedback. I mean, you might even think that you have a good idea going into something, and then you find out that, this other thing that was maybe just sort of an ancillary business is what ends up paying the bills. I mean, PayPal is a famous example of a company that started out as a security and encryption company that happened to take payments between, what were the handheld devices before they were our tablets? Palm Pilots and what have you. They were literally doing that, but because they had such good encryption and because they were so good at processing payments, they became, this sort of de facto way to process payments over eBay. But when they started doing that, had they imagined that was going to be the direction they were going to go in, they had no clue. Going into business is a lot like that. You start out with an idea and then you get some feedback. And so when it comes to setting up infrastructure, I'd be the guy to start out, like I did in the second bedroom of an apartment, and literally, the point where I said, okay, we're going to move into an office is, when I had 5 people in the second bedroom, and the icing on the cake was because I set up a receptionist in my hallway and customers were coming into my living room to do product demos. That was the point where I said, okay, it's time to put some infrastructure in place. when it comes to a lot of these regulatory things, there are places where you need to absolutely be proactive because it will bite you down the road, but bite off only what you think you can chew in the short term, and if you think that it's something that can come back to bite you 5 years down the road, deal with it maybe in a year and a half or 2 years down the road.
Okay. Okay, so what we're going to do now, first off, stop for a second. Coming back to the hashtag, we asked Mark. Mark, do we have any questions come through on the...
Okay, comments, no great questions. They all love you, Earl.
All right, perfect. Okay, so let's see. Cooperate here. There we go. So what we're going to do real quick is run through each of the sort of categories that Mark brought up at the very beginning in his presentation, and just what some of the specific issues are for each of those sort of categories of entrepreneurs. So, Mr. Legal, you want to kick this off?
Happily, there are categories that I know next to nothing about, so this happens to be the one that I do know something about. Investment advisors. Basically, we fall into two different categories, and those are those registered with the SEC, and those that are registered with the various states, Illinois Securities Department, the Blue Sky Regulator. The dividing line now between the SEC and the states is basically $100 million in assets under management. Requirements for federal registration: you fill out a Form ADV, Part 1A, Part 2A, and B. 2 is regarding the firm. 2B is regarding the manager. You need a chief compliance officer, federally registered. You need a compliance manual. You need disaster recovery plans, code of ethics, things along those lines. I'm not going to get into the investment advisor representatives, the individuals, but let's just say that state-registered investment advisors require a lot less regulation, which is good because that's probably where you're going to start out. The definition of an advisor under the Investment Advisor Act: any person who, for compensation, engages in the business of advising others through the direct publications, writings, as to the value of securities, advisability of investing in them, purchasing or selling, or for compensation as part of a regular business, issues or promulgates analysis reports concerning securities. Dial in through some of these things. What is advice? It's defined broadly. Generally, if a particular service is a step in the process that leads to an investment decision, the service is advice as far as the SEC is concerned. Some of the things could be evaluating companies, surmising materials that were filed with the SEC, things along those lines. What is in the business? Basically, without getting through all the definitions, but there's 3 different things to consider. Whether the service is solely incidental to a non-advisory primary business, you have another business. Specificity of the service being provided, whether the person providing the services is getting paid for that. Things that the SEC says are in the business: person who regularly advises, even on a part-time basis, persons who consider themselves financial planners, person who regularly gives advice on market trend characteristics and movements in general, person who regularly gives advice concerning selection or retention of other advisors. What is a security? I think a lot of us know what that is, but it's defined broadly, basically stock, bonds, options. But some of the other things are investment contracts, oil and gas partnerships, condominiums, certificates of deposit. We'll be coming back to it, but promissory notes is kind of a trap for the unwary. And basically things that are collectibles, commodities, things like that. What is compensation? Any form of economic benefit. Doesn't have to be a separate fee. Doesn't have to be the person receiving the advice that pays for it. Not really going to cover commodity trading advisors. Let's just say that you have different regulators, same general idea. Commodity trading advisors are regulated by the National Futures Association and CFTC to give advice on futures contracts and options thereon. Regulation of commodity trading advisors, again, I think this is mostly an equity group, so we'll kind of pass through that. And then, Earl, if you want to talk about education and or trainers, that's Justin's category.
Sure,
Actually, one of the things I want to ask, out of curiosity, are there people here who are either advisors or are interested in becoming advisors? just out of general curiosity. Okay, cool. Very good. Okay. Another thing?
With regard to education and training,
Yeah.
you know, I only really understand enough about educators and trainers to the extent that I partner with them. But, you know, I mean, from a regulatory standpoint, I'm really sort of completely aloof. I just have experience of working with them, to be perfectly honest.
Okay. And you're going to talk about the act.
Sure. Basically, one of the exemptions, there is an exemption, just like one for lawyers. A teacher who performs such services regarding giving advice on options solely incidental to the practice of his profession. So I think what the SEC has in mind is more teachers at school and things like that, and they want to know if there's state license and things along those lines. A lot of what we do as attorneys is basically, if people are familiar with the concept of a no action letter, basically what happens is someone comes into your office and they say, I want to do this, but how do I know that the SEC isn't going to come down knock down my door and get me in a bunch of trouble? Well, what you do is you write them a letter. You don't want to do it from your company. You have your attorney do it because they don't exactly know who the company is. And basically you say, my client wants to do X, Y, and Z. Will you take no action? And then you kind of go back and forth with them. They don't do it quickly. Of course, it's the federal government. But then when you get the no action relief that you're requesting, you know that you're not going to be in trouble for something along those lines. One of the other things about a no action letter is generally only the person who writes it in can rely on it, but that's not the way that things are done. Generally speaking, if Trading Technologies or somebody had a no action letter, there would be all kinds of people who would take the chance that the SEC wouldn't, say no Trading Technologies, you won't get in trouble, but somebody else doing the exact same thing will.
Okay, then we have sort of broad category of vendor consultant. That includes software developers, data vendors, any type of technology-related consulting. And just to sort of comment on that, I spent several years at a company called Interactive Data, which was a provider of financial data, and not just in the context of collecting it and distributing it, but we also had a business where we were rendering the opinions as to the value of fixed income securities. And one of the sort of interesting nuances about that is we had to register as a registered investment advisor, because there's a little clause in there that says if you are rendering any type of opinion as to the value of the security, you have to become an RIA, which was sort of an interesting, again, one of these sort of nitty-gritty things you had to deal with, because as even sales representatives for a data vendor, we had to do all the sort of compliance reporting that was required if you were actually an advisor. So if you're looking at getting into some kind of data or sort of opinion-related types of business, you're probably going to have to register. Again, things change, and it's one of those sort of gray areas where you really need to, again, contact someone like Andrew who knows and can research out to see if it's really necessary. So, I don't know, Justin, this is kind of your space. Talk about that a little bit.
Well, I'll tell you the biggest pitfall in consulting, and it's probably in any business that services customers, but managing your customers is the hardest thing, because there's this sort of fine line, especially because as consultants, we take these very complicated concepts that happen in the background and we simplify them. And a lot of times our customers will think that because we're presenting a simple solution to a very complicated problem, that it should be easier, because we as consultants make a very difficult concept look easy, that it is easy. And you have to have this very fine line with how you manage them, because whenever you're doing consulting, you're either doing it, fixed bid for a fee, in which case, you're trying to get paid as much as you can to do as little. And, there's a bit of risk analysis in that, right? You say, okay, well, how many unknowns are there to this project? Okay, great. I'll put a price on what the unknowns are. This is how much I actually think it's going to cost me to do it. Fine. But, you have to do a lot of, with fixed bid projects, you have to do a lot of educating up front to let them know what is actually involved in whatever it is that we're getting. But you can't educate too much either, because it'll remove the mystery from what it is that you do and what makes you good at your job. With regards to, project scope increases, and somebody says, well, I paid you to do X, Y, or Z, you have to navigate this very fine very fine line between whether you're too hard with the customer or too soft. I mean, it's very easy to just point to the contract and say, well, no, this is exactly what the writing says, this is exactly what I did, I delivered it, and I'll pay your bill. They might come back and say, okay, well, that doesn't solve my problem, so you did a bad job of listening to me up front. If you're too soft with them on the other side, they won't respect what you do, and they'll waste more of your time than anybody. And so you have to navigate and manage your customers almost, in a way where you're sort of gently nurturing and hurting, but you can't be too coddling or too soft, or your customers will waste more of your time than you can manage, and you'll start losing money.
No, I agree. That's one of the pitfalls we ran into when we started our practice a few years ago, is my partner had a great sort of comment. He goes, we're not the Red Cross. And it's real easy when you get involved, particularly on the front end, talking with somebody, first off, qualifying that A, they can pay you, and then B, sort of setting the expectation level about what you're going to be doing and being very clear about that. And that very much plays into what you're saying is, I think that's one of the things you have to consider, because in one hand, when you're getting off the ground, you really want to get into business, and it's real easy to sort of start giving away a whole lot of time and your expertise for no return. And then once you do that, it almost becomes that's the norm, and people sort of get into this groove like, well, okay, he's just going to call up, and anytime I call him, I can call him 24/7, and he's going to jump and give me answers. And that's one of the things you really don't want to get yourself caught into, because you're going to end up spending a whole lot of time for no return.
One of the ways that we addressed that is that we have certain things that are productized, and some of them are even consulting products. Some of them are even consulting products. One of the things that we do for support of those consulting products is we actually have trained our customers that what you're paying for if you call our support desk is an immediate answer, even if that answer is that you screwed something up, or that it was a user error that caused a problem. And so what we actually do is we run our support department as a voice, the same way that a voice brokerage might run. It's $25 a phone call. Why? Because the guy who has real problems doesn't care about a $25 haircut, but the guy who's just going to call and complain and waste your time because he's losing money and he wants you to lose money too, they won't call you because there's a little bit of a barrier there.
Okay. Yep.
Anyone have any comments here? This is your slide.
My slide, yeah. Basically, this is mercifully one of the things I don't know a lot about, but I will tell you that people, if you're dealing with advertising, everything like that, you have all sorts of other regulators that maybe we're not familiar with in the financial services space, the Federal Trade Commission, your state advertising laws, things along those lines. So you have to be very careful about what you promise and along those lines. And of course, you're going to want to promise as much as possible because you want people to buy your product, use your product, and everything like that, but it can't be misleading. There's also concepts such as omission. You didn't tell somebody a material fact that they needed to know to evaluate your product.
One of the things that you'll also see as sort of a pitfall in this space is IP concerns. Every trader, let's try this again. Every trader likes to think that whatever it is that they have is unique and proprietary to them. And a lot of times it's none of the above. In fact, I had one guy want me to sign a 7-page NDA, and I had to go over and look through everything. And after I said, okay, fine, this isn't too bad, and most of it wasn't enforceable anyways, I signed off on it. he tells me what his strategy was, and I kid you not, I went into my pocket, pulled out a thumb drive, and handed it to him and said, yeah, here it is. My point in this is that in a lot of cases, traders will want to own whatever it is that you build, and the way that I've addressed this is that there are sort of things that are tools, right? And the configuration of your tools may be unique and proprietary to you, but the tool itself, usually as a software vendor, you want to retain ownership of it and sell it as many times as you can because that's how you get paid. I do, on the other hand, offer things that are, very, say, esoteric or very, custom and specific to a trading needs of a customer. Those things are actually, in turn, things that are not very widely marketable, so I don't feel very uncomfortable selling those things and letting them have ownership rights. But I do that with the caveat that if you want to own something and somebody else asks me for it, I'm going to be able to sell it again. And if you want to prevent me from doing that, it's the equivalent of selling a business. You have to pay me the present value of any future business that I might have to turn down. And then when they see the sticker shock of that, they just say, okay, let's just risk it and hope that, nobody else asks you for it. I've been doing that for about 3 years, and we have, a couple of ownership pieces or ownership levels that you can purchase in our MSA, and that's the way that we've addressed it. And I don't know if you have any other comments that you might want to add.
That's kind of one of the traps for the unwary. Basically, in the contracts with the people who are working for you, you have to define whether it's work for hire. If you have no agreement with somebody or something like that, then the person who designed it for you may end up owning it. So, that's just one of the things that right then and there, you may have not paid an attorney to draft their contract, you may have an oral agreement. That's just one of the things that can kind of come back and really bite you in the ass because, like Justin was saying earlier, you get into business doing X, Y, and Z, you discover you're really good at A, B, and C. So then you ended up firing somebody, he ends up owning your intellectual property, and how do you think that conversation's going to go when you ask him to license it back to you?
It's not fun.
Basically, this is one of the things that basically there's an exemption for publishers. That was one of the things that the SEC, in passing the act, didn't intend to cover. And
I told you they didn't talk about this.
Okay. Oh, there we go. One of the things that's exempted is a publisher. Here we go. So basically, it is a bona fide newspaper or news magazine, business or financial publication of general regular circulation. Now, this exemption is actually broader than that because there's a very famous case that we'll kind of delving into, but it covers people like Mark Longo being on the radio discussing options and things along those lines. But there's been a lot of problems where people kind of morph. They start out doing one thing and then they morph into something else, and they were an exempt advisor, exemption, and then they end up becoming non-exempt by doing some of the things that they shouldn't. And then I'll also talk about one of the other things is, guess what, you're exempt. You don't have to register. Isn't that great? But the anti-fraud rules still apply. I'll talk about a case way back from 2001 where basically you're exempt from registration with the SEC, but you're not exempt from the anti-fraud rules. And our friend Tokyo Joe, I'm not sure if he's in prison or anything like that, but he's certainly not an investment advisor anymore. So there was a Lowe decision in 1985. Basically, the SEC was wrong in construing the act. Basically, the Supreme Court held that publications sent to clients as a service are subject to the Advisor Act. Congress did not intend to regulate publishing investment advisor newsletters because they were non-personalized advice. So saving you reading all the cases and all the examinations, but I'll just break it down. Impersonal investment advice is that not tailored to the investment objectives of a client. So when some of the registered investment advisors were up here earlier, they are a fiduciary and they have personal relationship with their clients. So non-personalized communications, basically what that means is you're giving the same advice to all people out there, and you're not really varying it depending on their facts and circumstances. You don't have investment discretion. You're not trading their assets. You're not sending signals to a broker-dealer to buy or sell securities. So, as I said, the Act is meant to cover personal investment advice, which looks at a particular need or a specific portfolio. You are allowed to talk about specific securities because that doesn't make it personal in nature. Bona fide in this situation means genuine and disinterested commentary and analysis, opposed to the slanted materials put out by a tout, like Tokyo Joe. So publishers, like I said, Tokyo Joe case, he didn't disclose that he had positions in the stocks and was being paid by certain companies to recommend them, nor did he disclose that he was trading ahead. So basically, he's not only a tout, he's also scalping. Did you comment on? Things that are problematic if done by a publisher are special access. Think back to the internet, chat rooms or something like that. One of the people started coming up with a risk profile looking at the age, income, cash, assets, tax, status, investment experience, and objectives. Again, there's a gray line. One of the things that I can help with clients is you look at the SEC doesn't really give you bright lines. If you want bright lines, you really want the CFTC. They like to keep it gray so they can always come back later on and say, you should have done this, you shouldn't have done that. But the difference between the publisher exemption and somebody who has to be registered oftentimes can vary on one different thing. So it's challenging for me. I have to get all the facts from you. You leave one fact out, the conclusion is different. So basically what attorneys do, we apply the law to the facts and give you an answer. So the other things is look at authority over funds, decision-making authority on investments or interactions that are individualized. All those things are problematic for publishers. Sorry, next category is broker-dealer and hedge funds.
Let me ask you this. Who in the room is interested in becoming a broker-dealer or is interested in setting up a hedge fund? Okay, moving right along.
The one thing I will say about
broker-dealers and hedge funds, I mean, basically they've taken away all the good exemptions. So if you wanted to do a hedge fund, you pretty much need to be registered as a registered investment advisor, a commodity trading advisor, a commodity pool operator. Broker-dealer, again, I think most people know now that you don't want to be in that space because it's not really the SEC or the exchange that's involved. It's FINRA, which is the combination of the New York Stock Exchange and the old NASD. Basically, there are too many responsibilities, too many risks and things along those lines. We used to have a very good business of setting up broker-dealers when people wanted to do that, but people really don't want to do that now, and I really almost have a hard time advising them to do that. Mark?
We have a question for coming for the panel today. On the Roadblocks to the new options business, does the bona fide news publisher protect Twitter as an exemption? They want to know how someone who wants to operate as a publisher, how can they use Twitter? Are they exempt from what they say on Twitter?
I don't really think that it matters how you distribute. One of the things that we'll be talking about a little bit later on is raising money for your new business, and that has changed quite a bit. It used to be that you really couldn't raise money out. The law was very antiquated. You couldn't really raise money on the internet, and now you can, subject to a number of exemptions. So I think we're going to cover that in a moment.
And the last category, and this sort of goes back to Mark's comment in the very beginning, we're kind of at an age right now where the whole industry is evolving so quickly, technology's changing, that, you know, we have these sort of general categories because those are categories that we got feedback from members of the Alliance and people in the industry, but who knows? There may be something new, innovative, new products, new instruments that will be coming out that are going to kind of change the landscape. So it's kind of like, stay tuned.
So I think that Andrew will actually have a field day with this one, and the reason why I say that is because innovation in this country is becoming actually increasingly illegal. We don't. I'm not kidding. There's if you want some offline reading or viewing to do, there's a great discussion between Eric Schmidt and Peter Thiel. Eric Schmidt being the founder of Google, or the chairman of Google. Peter Thiel being one of the backers behind PayPal and was a very famous early investor in Facebook. And one of the things that's happening, and we see this with companies that have an innovative distribution model like Tesla. They have this revolutionary electric car. They want to distribute it in malls and completely cut dealers out. And they're having problems in almost every single state with the establishment, digging their heels in and trying to make life very difficult for them. And so, Uber is having a very similar problem. That the cities all have medallions on top of the cabs, and that protects the hail. Well, any electronic hail from a phone is not technically that. Do you have to carry commercial liability insurance? Do you have to have a livery license? Are you protected from an electronic hail? What you see is if you want to be very disruptive, chances are it is illegal. And chances are you have to be very well funded because you take the Tesla route or you take the Uber route, and that is that you be incredibly well funded. You blatantly break the law and let the courts sort it all out, and you keep doing it and hope that you achieve critical mass faster than the law catches up with you. That's basically what I would say about disruption. The other thing that I would like to add is that there's another sort of thing, and it goes back to education and why there's going to be as much opportunity in education as there will be. And that is that income disparity in a lot of ways sort of tracks Moore's Law. And what I mean by that is that, Moore's Law states that the power of computers double every 18 months. Well, 150 years ago, we had horses competing with railroads to see who was going to be more powerful. In the 1980s, we had, again, machines competing with chess players to see who is going to become more powerful. In the 90s and 2000s, we had the floor traders competing with the electronic matching engine to see who is going to be more powerful. And every single time it displaces these groups of people who were previously in a business and they've been disrupted out of it and need to reinvent themselves. And the only playing field leveler that there is education.
The one thing that I'll agree with Justin on that is I deal with a lot of regulators, exchanges, FINRA, NFA, and everything like that, state blue sky regulators and everything like that. The one thing that I think really is a challenge is there's truth in what he's saying, but for me, we're now a one-strike society. You used to have 3 strikes with regulators and everything like that. These guys weren't doing their jobs. They got caught with their pants down, and now they're trying to show how tough they are. FINRA is regulated by the SEC, so you have a number of people who, they're trying to close the barn door after the horse already got out, to use a farm analogy and everything like that, which makes my job incredibly challenging, and which makes your job as entrepreneurs in the space challenging as well, because, a lot of this is you're supposed to be taking risks as entrepreneurs and everything like that. One of the things I do is, I'm a securities and commodities attorney. I advise people on what risks are worth taking. Not to take no risk. That's what I learned working in-house as an in-house attorney, is not to say no for everything, but basically to explain the risks. These risks are worth taking. These risks aren't worth taking. And these ones, you're kind of on your own. I can make a case either way, but that's the challenge of practicing in this space and representing people in the financial services industry, in the year 2013.
When I talked for a few minutes about funding, we're not going to get into a lot of sort of the nitty-gritty on it. I think the key one we want to talk about is the whole crowdfunding issue, right? And I think that's the main thing people hear about. I mean, one of the comments I have about funding, one of the things that we see all the time when people come into our consulting practice is they've gotten off the ground with family, friends, and country club money. And the problem is with that, you get with that money, a lot of times come cheerleaders that are going to be sitting there going, you rah rah, sis boom bye, you're a genius, this is a great idea, and nobody's asked them tough questions. And then you see they burn through that money, and then they come and they're saying, hey, they'll go to like an angel group or something and say, hey, we've got this great idea, and they'll talk to them and say, well, we just burned through $285,000, and we haven't even got a prototype product up, and we need another $500,000. And the angel investor is going to like throw you out the door, or they refer them to us and say, hey, can you help these guys out? And again, it comes back to my partner saying with the Red Cross, but at that point, they've already run out of money. And so that's one of the things you got to watch out when you're starting up is if you're tapping friends, family, whatever for money, they're probably going to be cheering you on and aren't necessarily going to be asking you the tough questions that they should be asking you about the viability of what you're doing. So let's talk about crowdfunding real quick.
To really understand where we are with the Jobs Act, we have to go back to what basically, the way it used to be, safe harbors, Reg D, unlimited accredited investors, 35 unaccredited investors, but no general solicitation or advertising. The securities laws were written in the 1930s, way behind the times, essentially what Earl's talking about, friends and family, and those you have a pre-existing business relationship with. Fast forward, one of the things you won't want to blow is the blue sky law. If you don't make all the disclosures you have, or you blow an exemption, which you have the burden of proof on, proving why you don't do a public offering, what Illinois law says in all the states, you get your money back. Rescission, 10% prejudgment interest from the time you invest to the time you receive your money back, attorney's fees, filing fees, expert witness fees. That is truly a heads I win, tails you lose. One of the things that I've noticed is very, very sophisticated people, they'll invest in a venture. If it's successful, I think I'll hold on to it. If it's not successful, guess what? You're going to hear from my attorney. So not only did your venture fail, and you have to deal with that, you have to deal with that sort of liability. And that's one of the things that I do, is I draft the documents that make it legal for you to take people's money and not get in trouble with the regulators, because the worst thing you want to do is go to a meeting where you can't take the people's money. You may never get at that meeting again, and, that's kind of crap for the unwary. So you want to go with your documents ready. We should change it under the Jobs Act. General solicitation and general advertising are allowed if you only accept accredited investors. I think most of us are in the financial service space, we know what that is, but I'll just run through really quickly. People who have $1 million net worth, not including their home, people who have certain high incomes, $200,000 if you're single and $300,000 if you're married in the last couple of years. So now you can use the internet, billboards, cold calling, ads in Crane Chicago magazine looking for investors. Now you have the bad boy provisions. No felons or bad actors. People can have dings on the record. You may not be able to raise money or be associated with these ventures. Verification of accredited investor status. It used to be you just checked the box that you're an accredited investor, and that was good enough. Now the SEC is, in their infinite wisdom, changed that around, and you're going to have to show that you truly have the income or assets, which a lot of wealthy people aren't really willing to do. If you're the Pritzkers, do you really want to show how many billions of dollars you have or something like that to a venture capital firm? The very recent proposal, and this is the true crowdfunding. This is a proposal from the SEC came out like last week. Crowdfunding, as people don't know, if you're familiar with Kickstarter, is basically raising money. Well, you don't raise money with Kickstarter. Kickstarter is basically a bunch of strangers who donate to an artistic venture. But you don't own anything, you may get a t-shirt or something along those lines. Well, the SEC came out, Congress decided they were going to pass a law, Jumpstart Our Businesses Act. The SEC was only 2 years later, 1 year late and 2 years later, coming out with the regs. These are the proposed regs. But these things are truly dynamic and really have a possibility to shake things up. So raise money over the internet. You don't need a broker deal anymore. You can do. There's going to be a category of licenses called the funding portal. Businesses can raise a maximum of $1 million per 12 months. There's a 1 year holding period for investors. So if the company wants to raise over $500,000, it needs and audit, and basically small investors, people who have even less than $100,000 in income or assets, can invest in these ventures. Same thing with people over $100,000. There's a cap of $100,000 in total for crowdfunding. This is truly revolutionary. To really understand it, that's why I had to go back on a couple slides. People like us who have been practicing in this area for a long period of time, we don't know what to think. There could be a lot of fraud associated with it, or it could be like a true renaissance. Because one of the things you're going to have trouble with is raising money for your new venture. You may have the greatest idea ever. I work with companies who I introduce them to capital sources. They have great products, but you'll hear from private equity firms, well, we only do healthcare or technology or things like that. You know, there's so many people that say no. They're looking for reasons not to do it. So I think this really could be revolutionary. Justin's going to weigh in.
Well, I'm one of those guys who say no, in the sense that generally when it comes to funding, for all of the reasons that Earl mentioned about, how I took $200,000 of friend and family money, I pissed it all away, and now what can I do? I started Scale Dynamics, like I said, with $7 in my checking account in 2010. And it forced me to get very creative and, to have realistic expectations about what it was that I was doing. And a lot of that, sort of lean, mean, it has to work mentality has sort of forced me to cut out a lot of ideas and cut out a lot of things that were just simply impractical. Then later on, when I did raise friend and family money, I was coming from a position where I was cash flow positive, where I had a product, or at least the makings of a product, and I already had some semblance of a business going. I've talked to VCs and I've talked to angels, and I've generally come to the conclusion that VCs are not your friend. I would encourage anybody who is thinking about raising VC money to read a book called Raising Venture Capital Money for the Serious Entrepreneur, and it actually gives you a window into how VC firms make money. When a VC firm looks at a business, they look at you as really only one of two things in a binary outcome. You're either a write-off or you're a home run. If you give back all the money, or if you even give them back double, you're in VC land considered to be what's called a sideways deal. So know that if they're going to give you, say, $1 million, they fully expect you to give them $10 million back in 3 to 5 years. They have a lot of protections that are put into place that are designed specifically to where they basically can ratchet up things like anti-dilution clauses. If you end up having to go back to the well and raise more money, they can basically, buy their equity back, or they can buy equity from you, more equity, and you as a founder are, the sole source of dilution. They also have things like exit preference clauses, where they'll say, okay, I want a 3 times multiple at the very least. So if you sell a company, say that you take $1 million from them, okay, and you turn around and you give them a 10% stake in the company. A year later, you sell it for, say, $3 million. They take every single nickel of that $3 million because they're entitled to the 3 times multiple of whatever they put in. They take the first, 3 times multiple of whatever they put in, and then whatever is left goes back to the founders. So the terms that they have are, rightfully designed to protect them. But if you don't know what you're getting yourself into, I would strongly urge you to stay away from it. On top of that, if you aren't experienced at raising venture capital money, I would also say stay away from it, just because the amount of time and distraction from running your business to educate yourself might, force you to miss the ball. When it comes to angel investors, there's 2 types of angel investors. There's, the smart money, which are basically small VCs. And then there's the dumb money, which a lot of times is friends and family, the cheerleaders. Same rules apply to smart money, angel investors. They're basically the equivalent of a VC. dumb money actually has a little bit more of a personal touch. First of all, they're going to cheerlead you on. They think you're the smartest person in the world, but you have to manage their expectations. You have to let them know that they can lose every single nickel, that this is going to have a binary outcome. And secondly, you have to let them know that at some point down the road, if things aren't going well, or even if they are going well, but you're at a cash drawdown, you have to let them know that not only am I asking you for money now, but I'm going to ask you for money down the road. And you're going to be in the seat where you're going to either lose everything that you've put into this thing so far, or you have to double down. That's all I really have to say.
Okay. And I guess we need to kind of wrap up because we're running over. One of the things that we're doing is on the Options Alliance website after this meeting, we put on here some links. These are just some resources that I think are worth taking a look at if you're looking at starting up a venture and have some sort of interesting resources that you can tap into.
Earl, do we have time for one more thing? Because I know you and I have talked about it before. It's the entrepreneur's paradox, and I know Earl sees this because he's helps people raise money. The 100% of something, 100% of nothing versus 50% of something. I know that people, when it's their baby and everything like that, they're very reticent to take on investors and things along those lines. But to really get to the next step, you really kind of have to take on investors or get some help. Maybe you could talk about that.
No, that's right. I think what happens, we want to wrap up here and get going. So if you have any questions, grab us at the break. And, the purpose here was really not to discourage you. A lot of the stuff we got into was like really into the weeds on a lot of different issues. If you have ideas, that all means go for it. I think the main message we want to communicate is do your homework and look at and really assess, is your idea really viable before you start diving in and putting all your financial resources and time and money into it. So that's it.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.